All right, good Thursday afternoon, Finom Group members and our broader audience. Welcome to this week's weekly State of the Market titled Some Great Tips. It's not what you think, though. It's not what you think. It's not going to be about investing or trading tips in the sense that we're going to talk specific stocks. We are going to talk and we are going to offer some tips. With that being said, our quote of the week: it's okay to be wrong. It's unforgivable to stay wrong. That from Martin Swig. Pretty right, because I love this visual aid. This just doesn't work, right? Another famous quote from Charlie Munger: I don't think you can get to be a really good investor over a broad range without doing a massive amount of reading. I don't think any one book will do it for you. Oftentimes people will ask me, Seth, what books did you read, when you were learning about investing and trading and economics and business and, charter for the CFA, Certified Financial Advisors. I didn't read one book. I didn't read 10 books. I didn't read 100 books. I literally must have read thousands. Still reading, still learning. And it's not just books, it's articles, blogs, websites, whether they're government, owned websites or financial service providers. I'm always reading. That's part of my research. It's part of my due diligence. It's part of my touch points with the market. It's just constant reading, constant absorbing of information, news flow, ideas, perspectives. Really, for a good investor, a savvy investor and trader, the reading never ends. It never ends. It can be tedious. You can't even get overload, but over time you'll figure out the proper sources. That's part of what we try to do at Finom Group, is deliver the most appropriate resources when it comes to analysis, technicals, macro fundamentals, and the sort. One of the things that we've recognized throughout the course of kind of segueing, and this weekly State of the Market might run long, by the way. We've got a lot to go through. But one of the things that we've talked about through the course of this post-pandemic bull market rally is how quickly dips get bought. And the chart in front of you shows you this particular one is not getting bought as quickly or with as much vigor as previous dip buying took place. You can see, and this is by retail investors. Retail investors' purchase of U.S. ETFs. This is a 5-day moving average, basically. You can see there were periods of time where the buy the dip impulse was much stronger than where it is right now. Having said that, at this 4,000 level, it's still well above where it was at the beginning of the year. They're still buying the dip, don't get me wrong. Don't get me wrong. It's just not as quickly or as robustly as they had in previous drawdowns in the S&P 500 index. 50% of what we do in the way of due diligence at Finom Group is to harden our emotional quotient, our EQ. And the other 50% is deciphering whether or not we should be buyers of dips. Using our buy the dip indicators. Recognizing whether or not this sale is the one to go running into, or if this is a sale to run away from, because it'll just keep dipping and dipping and dipping. The reality is still to this point in the bull market cycle, there's nothing that suggests we should not be buying the dip. We should not be engaging better valuations, right? We had a 5-day losing streak. We were up on Monday. Go figure. Monday happens to deliver the strongest returns over the course of the 12-month period. When we go back and we look at the data, Monday has actually delivered the best returns of any day of the trading week. And Monday was up, Tuesday was down. We took back everything that we had gained on Monday and then some. But then came Wednesday. Wednesday took back everything we lost, and then some to the upside. Here we are today. We were down a good 35 points at the lows here today. Very, very choppy action in the market. And it can be argued for both the bulls and the bears. The bears can say, well, you guys can't get it to go to new all-time highs. And the bears are probably saying, well, you guys are struggling just to, push us and keep us down below 4,500. It really is a bull bear, battle here this week with up and down price action each day. Serves to figure that would be the case during a monthly options expiration week as well. But again, most of what we're doing here at the weekly state of the market in our weekly research reports is hardening our emotional quotient and deciphering whether or not the dips in the market are in fact opportunities. All right, this is the latest study here from Steve Depp. Heading into Wednesday's trading session, the S&P 500 had gone 6 straight trading days with an open that was greater than the close. 6 straight trading days. These are all the occurrences, 22 going back to, looks like 1990. This has happened 22 times. When the S&P 500 was at an all-time high. The one-day forward return, supposed to be positive, 61.9% of the time. It's a meager return, but indeed, Wednesday we were positive. That one-day probability did pan out. 2-day return, we're going to find out today. It's usually positive, and the return is that much stronger at 0.65%. The probability of being positive is also stronger at 66%. A lot of 60s going out for, I think that's the 4-day return, 85% of the time, the market is higher. That would be Monday, I think, after weekly options expiration. So keep that study in mind. Indeed, we've been opening higher and we can't hold the gains. Right? The bears are, they're right in that sense. We haven't been able to make a new all-time high here in the last, 8 trading days now. So we've talked about this chart in the past, right? The 5-day win streak and what tends to happen after a 5-day win streak. You get that much momentum, kind of get into overheated, overextended territory in the market. And we usually give up a good portion of the gains that started from the 1, 2, 3, 4, 5. This was a 7-day win, which is why the dip was that much bigger. And it was a 3-day losing streak there. But then, we had another 5-day win streak. We gave up some of the gains. We consolidated here more so for time. And that ran up against another 5-day winning streak. What happened after the 5-day winning streak? 2-day losing streak. We gave up pretty much all of the gains. Then we had another 5-day win streak. Little dip here, but we went right to a new all-time high. Fast forward to the present, and look what happened. After the 5-day win streak, even though we made a small dip and made a new high, we're giving up almost all of the gains. Remember, this last 5-day win streak here started at 44.05. We haven't given up everything. The low that we hit yesterday, or 2 days ago on Tuesday, was 44.34, I believe, just above the 50-day moving average in the S&P 500. So we still haven't given up all the gains yet. And it's been really rocky, though. But in terms of knowing what happens after a 5-day win streak, yeah, you usually do consolidate price, consolidate price, consolidate price. So nothing's happening that's out of the ordinary. The market has prepared us for it with constant message of expect pullbacks, expect pullbacks, expect pullbacks. Nothing out of the ordinary. Here we are again. All this, bull bear tug of war that's taking place is taking place in monthly options expiration week. And last week we discussed S&P 500 monthly options expiration weeks for September, going all the way back to 1982. Has a pretty good win percentage at 59% of the time being positive for September monthly options expiration. We are actually slightly higher on the week despite all of the ups and downs. We've already taken out the greatest gamma exposure so far as the open interest in SPY options at 40, I think that's 450. We took that out on Tuesday. Took that out. The next greater strike is 454 here. If it was lower, we're looking at 445. We actually took that out also, I believe. So a lot of the downside gamma has already been achieved. Having achieved the strike early in the week, dealers now have less demand on delta hedge henceforth for the rest of the week. Will prove an interesting monthly options expiration given a lesser gamma flip risk. Having said that, you know, when you speak to gamma, you speak to gamma flip and monthly options expiration and how we're setting up going into next week's FOMC meeting, don't forget that, folks. Like I said before, it's like every week there's something on the horizon. The wall of worry just, you know, is a constant for which the S&P 500 tends to climb. But these are the latest notes and configurations from Charlie McElligott, who is the chief strategist at Nomura. And here's what he says. Options positioning has clearly turned with the S&P 500, the Qs, and the Russell Small Cap ETF all in negative gamma versus spot territory as of today. That was yesterday. Although 3.3 billion of gamma at the obscure 4430 strike matters, which is helping us hold. Indeed, you know, we didn't drop below 4430 there yesterday. Delta still net long, positive for S&P 500 as a potential source of de-risking flow. 66th percentile at 205 billion flips negative delta below 4388. If we get down there, we got problems, basically. In the short term, Charlie McElligott notes share buybacks and vol control algos are looking to buy the dips. Vol control still set to load up Thursday and Friday, approximately 15 to 20 billion, depending on daily changes between 0 and 50 basis points. If this is all Greek to you, just hold on. However, next week and beyond is the deallocation, de-risking enormous notional supply potential in 1.5% or greater daily change environment. Meaning if we get that kind of IV, implied volatility, of daily changes in the S&P 500 of 1.5%, you know, the vol targeting or vol control strategies are going to be de-risking, right? Because I mean, a move of 1.5% a day, especially to the downside, you know, that's a volatile environment. We would probably be seeing the VIX back in the 20s, if not mid 20s, in that environment. The trick here, warns the Nomura strategist, is the magnitude of a potential sell-off between now and the Fed, because the normally reflexive vol selling into these options expiration gamma unclench vol expansion windows experienced year to date could be held off into the likely upside risk in the Fed dots update release. This could go either way, folks. In my opinion, this is a goodly amount of noise. He's basically, it could go either way. We could get de-risking or we could have upside risk. Because really the Fed tapering is likely, the tapering message, the plans to be announced on tapering, I think most of the strategists and analyst community are of the opinion at this point that it's off the table for next week's September meeting. And because there's no October meeting, that really just leaves November as the earliest potential messaging of Fed tapering plans. At this point in time, and this is what I've said for months now. Remember, I said September is just a bad month to do it because you have the unemployment insurance benefits rolling off and you have the eviction moratorium rolling off as well. And there's no telling what the ramifications are for that without time playing out. So September was always going to be a bad month, regardless of what the previous non-farm payroll report, having been as weak as it was, had to offer. All right, some more here on options expiration and gamma, if you will. Spot gamma notes that it appears that positions are filling in around 44.50. While little of this position expires today in S&P 500, roughly 20% of SPY gamma expires at the close, which should add to volatility into Friday. And we certainly have some volatility here today, Thursday. Spot gamma thinks one of these ends in tagged. One of these ends, either this one or this one, 4,400, I believe that is, or 4,500. One of them gets tagged. Okay, within 34 points of tagging the bottom just 2 days ago, but we also came within 15 points of tagging 4,500 yesterday. It's noise, from one day to the next. And how does this affect the positions in your portfolio, really? It's a lot of noise. So we are halfway through the month. We are in monthly options expiration. September, we are seeing the selling. We are seeing the selling, the seasonal headwinds that we have often talked about for the month of September, which is typically a down month. We've also countered that with various data points and studies about how strong, the year is in the first half of the year actually delivers a positive return in the month of September. But you never know for sure. There's no guarantees with any of the seasonal data, let alone the historical data, quantitative data. What we do know is that most of the seasonal headwinds for September actually take place after the third Friday of the month, or for the 17th starts the worst period of September, down 0.23%, down 0.29%, 0.15%. Basically, most of the losses that occur in the month of September happened in the back half of the month. Things get rougher after the third Friday in September historically, where the majority of the losses come into play for the month. Here's September. These are the bigger losses. You got green and red in here, a lot of green and red. This is mostly red and yellow. Indeed, here's a study from Quantifiable Edges. Let's say today is the third Friday of the month in September. If you bought on that day, the bearish tendency presented in Table 1 appears quite strong. The S&P 500 has been lower over 80% of the time, going back to 1990, 80% of the time, 4 and 5 days after the third Friday of September. The only instances not to post a lower close at some point during the following week were in 2001 and 2017. The 9/11 attacks certainly made for unusual circumstances in 2001. 2017 did not see a decline. The S&P 500 only rose 2 points in 2017. So even though the market didn't fall over the next 4 and 5 day periods after the third Friday of the September month in 2017, it was only up a stinking 2 points. It's not a real victory for the bulls. Corrections. Everybody's still clamoring for that 5%, 10%, even greater correction. What this chart basically shows you is that corrections have happened. They just haven't happened at the S&P 500 level. They've happened for the NASDAQ here, down almost 12% in the NASDAQ back in March. S&P 500 energy, come on. It's been in correction territory for a while now. Consumer discretionary, also back in March, largely because of Amazon, Tesla, Home Depot. S&P 500 materials, as of July, they were down more than 10% as well. I mean, we could show various different ways of where the market has executed a correction. It just hasn't happened for the S&P 500 as a whole. Does that matter to folks like Mike Wilson, Morgan Stanley's chief equity strategist? This was August 17th. August 17th. Year-end target, he boosted to 4,000, calling for a 10% correction nonetheless. Yes, 2 days ago, on Tuesday when the market was red, September 14th, here he is again, correction coming. He's been doing this literally since June of 2020, just about every month. The market's overdue for a correction, right? That's just what people's mentality is. You haven't had a 5%, let alone a 10%. Something bad must be coming, right? Just because the market is due for a correction doesn't mean you get your correction. Best thing for you to do is to align yourself with the primary trend in the market. And when the correction comes, because it will inevitably come, just know what to do should you be a dip buyer. Kramer coming into this week. Kramer's week ahead. I need you to expect some brutal days ahead. This week has been, very much a roller coaster ride. But the market is slightly higher on the week. We still have Friday to go and the end of today's trading session, so who knows? Does this, give you any comfort? Does this help you with your emotional quotient? This is what I wrote in our weekly research report. What the headlines really beckon investors to do is to focus on the decline itself, which distracts from our game plan. Chronologically speaking, when we focus on the potential further price decline of the market, we then focus on trying to chart or rationalize the ultimate magnitude of the decline. This is a fruitless labor, a trap that many investors get sucked into. I would rather desire investors and traders focus on the fact that when valuations improve, while the fundamentals haven't deteriorated enough to disrupt the earnings trend, this is a net positive for investors who are long-term oriented. Buy the dip. Carter Braxton Worth of Cornerstone Macro, he's their certified market technician, often found on CNBC. This was his thoughts coming into this week. September 10th tweet, hard down next week, our best guess. CNBC, CNBC, CNBC. You see the theme here about financial media? All right, we've had 5 consecutive down days in a row and the bears come out of hibernation. When everyone thinks the market will zig, don't be surprised if it zags. As the old saying goes, the market likes to make a fool out of as many people as possible. Well, we've ended a long streak of the number of consecutive days. Greater than 75% of S&P 500 stocks were trading above their 200-day moving average. On Friday, that streak ended. Again, that was, second longest streak. The streak ended last Friday. 73% of stocks were trading above their 200-day moving average. On Monday, it jumped back to 76%. Then it jumped back below 75% on Tuesday. Up, down, up, down. Here's a study from the Sentiment Trader. In over 90 years of history, there have only been 5 other streaks of at least 200 consecutive days where 75% or greater stocks were trading above their 200-day moving average. Like we see with many momentum types of data, forward returns were good, even after the streaks ended. While it did precede a big dip in 1950, the other 4 cases saw minimal losses or gains over the following months. The S&P 500 itself is now 10%, speaking of the 200-day moving average, the S&P is 10% above the 200-day moving average, which that is actually less than it was a month ago. A month ago, it was about 11.5% above the 200-day moving average. Now it's only 10% above the 200-day moving average. A lot of time correcting going on here. All right, why do I bring this up? Well, I bring it up to refresh a study that we had mentioned back in July. Solid returns for the year when the S&P 500 does not have a daily close below its 200-day moving average through June. But this does not tell the entire story. All right, so if we haven't had a close below the 200-day moving average through June, we'll look at the Q3 returns. We're still in Q3, right? Until next month, we are still in Q3. We have not had a close below the 200-day moving average. We've been basically double digits above, percentage points above the 200-day moving average since about, I want to say the springtime. So Q3 returns are positive 64% of the time, up about 1.2%. Q4 returns, not unlike what we, other studies that we've seen that, suggest we should see the final 4 months of the year with positive returns. Same final 3 months in this case. Q4 return, positive 85% of the time. Average return, we'll call it 9% for round number sake. Haven't had a closing below the 200-day moving average through June. Obviously, here we are in September, still without, and indeed, market has been up since June. Number of days since the S&P 500 came within 0.75% of the 50-day moving average. And so we can see basically in 2021, while the S&P 500 has not closed 2 consecutive days below its 50-day moving average, the time that we're spending above the 50-day moving average is becoming shorter and shorter and shorter. We're finding ourselves testing that 50-day moving average more often lately. I would be of the opinion, it's not an opinion, it's actually a fact, but you have to think about it in physics terms. The slope is largely due to the fact, the slope of the 50-day moving average, largely due to the fact that the 50-day moving average is rising in an extended uptrend that has not expressed a meaningful correction in over 220 days now. The time-based moving average rises. 50-day moving average, the 200-day moving average, the 100-day moving average, they're all rising in an uptrend, even when the S&P 500 dips or moves sideways. The 50-day moving average right now is moving higher by about 7 or 8 points every single day. That's how it works. So naturally, it's going to edge higher. If we go through this sideways period or even a mild, drawdown, we're going to hit that 50-day moving average faster than where we, were at the beginning of the year. It's moving up, but we're moving up slower. Corrections, again, corrections take place in many ways and for many reasons. In contrast to what many may think, market is pricing in some kind of slowdown or normalization of GDP growth. It's just that a tilt back in favor of tech and secular growth shares can create this perception that stocks are oblivious to, some of the slowing economic data. Earlier this year, many suggested the broad market might not be capable of making new highs if the tech titans fell out of favor as the recovery rolled along. What we're seeing now is the opposite of that. So if you look under the surface or look at bond yields or just divide small caps by the S&P 500, right? This is the relative performance ratio of the Russell versus the S&P 500. You can see we've had a correction. There's so many different ways that corrections can happen. But most people just, they get fixated on the benchmark index, the S&P 500, and executing that perfect textbook 10% correction, while other indices have already done that. And even being, at the large cap S&P 500 level, we haven't, but at the mid cap level, we have, at the small cap level, we have. So corrections have happened, folks. JP Morgan's analyst said Wednesday that the bank doesn't expect permanent demand destruction from the fourth COVID wave, the Delta variant, but rather a delay in the global reopening and economic normalization. Consistent with the point made above about the market pricing and the slowdown, despite stretched equity positioning, the lack of a material derating at the index level, meaning the S&P 500 drops. Relatedly, the conspicuous absence of a 5% pullback, the JP Morgan analyst noted that risks to growth are not only well flagged, meaning understood, but actually overdone in some cases. For example, JP Morgan COVID recovery basket has reversed its year-to-date performance, taking multiples back to post-pandemic lows. This is the basket of COVID recovery stocks, and they're basically back to the COVID low. So when people say the market hasn't corrected, the market's not, it's oblivious to some of this economic slowdown or normalization. That's just not true. The most economically sensitive areas of the market indeed are pricing that in and have been pricing that in, as shown in that chart right there. The JP Morgan analyst called consensus estimates too conservative at this point, largely due to ongoing fears and related inventory shortages. In the bank's view, those jitters will abate, with the Delta wave leading to a much stronger holiday season and a pickup in cross-border activity from still depressed levels, meaning global trade, global travel, and global commerce. The Bank of America analysts lifted the bank's EPS estimate to $210 a share, which is still below ours at Finom Group. I think we're at $214 from $205. I know they raised their estimates also. JP Morgan's new year-end S&P 500 target is 4,700, up from 4,600. So we've had some, negative Nancy's, if you will, or Debbie Downers, Debbie Downer, Mike Wilson, Debbie Downer, Carter Braxton Worth, Debbie Downers, and just balancing it out, various opinions. We want to hear what the bulls have to say. We want to hear what the bears have to say. Never bias your information flow and analysis. Put it all in the meat grinder. Give it, careful consideration. And I trust that you'll come out with the right observations. What about a correction due to high valuations, right? Everybody, the S&P 500 and the technology and the NASDAQ are overvalued at this point. The reality is, look, if we're at the S&P 500 level, this is where we were a month ago, 21.3 times earnings. If you take out FanMag, right, Facebook, Apple, Amazon, Google, Netflix, Microsoft, if you take those out, the S&P 500 a month ago was trading 18.7 times, 21.3 and 18.7. Fast forward to the present, 21.2 and 18.6. And here's in the red is the S&P 500, in the green is the S&P 500 without FanMag. And look what's been happening all year long. Stocks have become cheaper. The S&P 500 has become cheaper as the year has progressed. Again, so when people say, market's overvalued, okay, what do you think at the beginning of the year when the S&P 500 was 3875? And here it is, round numbers, 4,500. What can you do with this whole notion of I can only allocate based on valuation? You would have been sitting on the sidelines this whole time, and you're still making the same valuation argument. You've missed out on a 20% gain in the S&P 500 for the sake of high valuations. A lot of things that people say and do and promote, financial and social media, they're not practical. They may sound smart. And it always does sound smart when you speak of the market in terms of highly valued and risks to the downside. That always sounds intelligent. The reality is the market wants to go higher. The conditions, lend themselves to the market to go higher, despite, the concerns about, or the walls of worry, all the bricks in the wall of worry. All right. With that being said, got a lot of good data out this week. We've talked very much and at length over the course of this year about inflation, or as I refer to it, reflation. And one of the things that we focused on was the base effects from last year and how they would manifest themselves with above average inflation rates here in 2021, right? We saw inflation basically nosedive last year, February, April, May. Then when we started to reopen very slowly the economy in June, we saw inflation come back, normalizing economic activity. Here this year, April, May, and June, we are lapping these base effects, which has produced this above average inflation rate, right? We're in the 4 and 5% range right now. But what we've seen and what we've expected or anticipated based on our analysis of past inflationary cycles, think of the 1970s, 1950s, is that, over time that inflation will almost automatic, I don't want to say automatically, but you get my point, naturally ebb lower over time. And so when we got the CPI data out on Tuesday, that's exactly what we saw. The reality is when we got the CPI for the previous month, we started to see the drop off. It's that much more pronounced on a month-over-month basis after Tuesday's release of the August CPI, Consumer Price Index. So this is playing out just as we expected. Not only that, it's also giving credence to the Fed's mantra of transitory inflation. This is a good thing. Why? Because it pushes out the probabilities for a rate hike. They're already way out there in 2022, late 2022. But, the Fed so far is looking pretty smart. Despite all of the hyperbole about sticky inflation, we are seeing the ramifications of the base effect play out now. So second month in a row, month over month, CPI has come down. Inflation is still going to be a theme. It's still going to be pondered. It's still going to be concern, going forward, because, 2 months does not make a trend. So it'll still catch headlines. It'll still be part of the narrative for the remainder of this year and into early 2022. Wage inflation is another, aspect of inflation that has been highlighted because we are seeing some, the best wage inflation since 2008, basically. Corporate managements have been particularly focused on labor market dynamics. Proportion of U.S. firms mentioning labor or wage in quarterly earnings calls, right? it's the most that we've seen since 2008. Some notes on that. Like, is that something to be concerned? Because wages are a significant cost input when it comes to corporations. It impacts the bottom line. Some notes here from Goldman Sachs basically say, it's more noise than it is impact. Our analysis suggests 100 basis point acceleration in wage growth, meaning wage growth moving yet another 100 basis points higher, would reduce S&P 500 EPS by just 1%. All else equal, in line with the historical relationship between earnings and wages. Among sectors, industrials and the consumer sectors appear most vulnerable to rising wages. Small caps are generally more exposed than large caps, in large part because they have lower profit margins. 1% hit to the S&P 500 EPS. And that's probably not even going to happen. That's probably a worst case scenario. How does that, what does inflation mean for investors, right? That's what it all comes down to. Well, I mean, this helps tell us we shouldn't be worried too much about wage inflation because it's got a very, very small impact on EPS. If that being the case, we shouldn't worry about, inflation as it pertains to S&P 500 returns going forward. People always get, inflation, that's bad for the economy. It must be bad for earnings. Remember, the market and the economy, they're not, one-to-one. They're not one-to-one. As you can see from the table of inflation zones, these are the inflation zones. Inflation less than 0%. This is according to CPI, Consumer Price Index. So when it's less than 0%, returns are spectacular on an annualized basis. 0 to 1%, 1 to 2% gets pretty good again. 2 to 3%, either way, but double digits. 3 to 4%, a little bit less, 7, 8%. 4 to 5%, it gets good again. 8, 9%, almost 10% annualized EPS. Right now we're at 4 to 5%, by the way. But we are going to normalize probably around this level next year. So, point is, everybody always worries about inflation, for market participants. The reality, it has no real utility in terms of what it means for the market. It's earnings. Earnings are what matter, not inflation. And inflation actually, as long as the consumer's balance sheet is strong and they can absorb some of the inflation, it's actually a boon for S&P 500 earnings. So good chart there. And here's another study from Bank of America. We talked about this a couple months ago. It's always good to refresh and bring these back into focus, make sure, we're operating under, the standard, if you will. The only periods in modern history whereby the S&P 500 was lower as inflation rose or as the CPI rose was 72 to 74. And folks, it probably was. The problem then was the oil embargo, obviously. And you had the Cuban missiles, we had the Nixon issues. But when oil goes from, skyrockets more than 100% in less than 12 months, that's going to ruin any economy. And that was the 1970s. Since then, nope. And this goes all the way back to 1919, this data. During rising inflation cycles for the CPI year-over-year index, the S&P 500 has traded higher 80% of the time with an average return of 25%. Hello. 80% of the time in inflationary environments, the market is up. You need something else going on to take the market down. You need a big catalyst. And again, 1970s, you had that. You had it. It was more anomalistic than anything else. And I spoke to, can you pass along those increased costs to the consumer? If they can absorb it, you're in good shape. JP Morgan thinks, indeed, they can absorb it. Savings of consumers invested a portion of into risky assets. The cumulative excess savings for consumers since the onset of COVID is at 2.4 trillion. That's this number here, excluding the likely boost from rising asset value. So that's not even considering your home price appreciation if you're a homeowner. It's not even considering that. The average monthly rate of excess savings over the last 3 months has been 25 billion, which contradicts the view of a drawdown in savings. All right, Florida weather. We got disrupted there for a second. Okay, we're back. All right, so the average monthly rate of excess savings over the last 3 months has been 25 billion, which contradicts the view of a drawdown in savings or cutback in spending response to fading government benefits linked to the pandemic, right? Everybody says, oh, the benefits are rolling off, so consumer spending is going to roll off. But the consumer has actually gained another 25 billion. As such, these significant excess savings should more than buffer headwinds that consumers may face from decreasing government stimulus payments and rising consumer prices. More so, as new jobs keep getting added and wage growth persists, that should further support the consumer setup, questioning whether or not consumers even need to dip into their excess savings. Right? Because all we hear, we just get one side of the narrative when it comes to the financial media and the bearish, analysts like Mike Wilson. We hear one side. Well, the government benefits are going to roll off. Yeah, but look at the savings rate. What about wage inflation? Right? Like I get Mike Wilson's reports every week. I don't see anything on wage inflation in there. I don't see anything about job openings in there. Like for every con, there's a pro. Every pro, there's a con. Nothing goes up in a straight line. The economy is not a perfect instrument. It ebbs, it flows because it's not perfect. So in closing, JP Morgan is bullish on the U.S. consumer. The consumer has 2.4 trillion excess savings war chest. Americans with limited options to spend during the pandemic saved more than usual. And while it's unclear how this money will be spent, everyone agrees this is awesome for the economy. Why it matters? Wells Fargo estimates that the 2.4 trillion in excess savings has been accumulated by consumers since the beginning of the pandemic, and consumer spending accounts for 68% of GDP. As the consumer goes, the economy goes. And what does this all add up to? Huge earnings numbers. Higher wages, higher inflation, best consumer household balance sheet in 60 years. 2021 has seen the fastest improvement in earnings expectations since at least 1986, 26.2%. 1986, all the way back here is the highest estimate there, 26.2%. Higher inflation, higher wages, best consumer household balance sheet in 60 years. That is not bad for the S&P 500. Okay, we are going into next week, FOMC meeting. We talked about this in our weekly research report, the chart in front of you. If the market desires to correct for the sake of something that doesn't impact corporate earnings, because tapering doesn't impact corporate earnings, folks, all the better. All the better. If it's going to, correct because of fears of tapering and just the headlines kick off algorithms, fine, all the better. Make it rain. Improve the market soil for rich harvesting in the future. You'll notice in the chart above, the tapering announcement of 2013 caused more market volatility than the actual tapering that began in 2014. This is the VIX. This is the tapering announcement timeline. VIX goes down. Wells Fargo senior market strategist Scott Wren. These are his notes on all things macro related at this point. There are a number of reasons why the equity market might not adhere to the historical seasonal tendencies this time around. Our view is that economic growth will remain strong and interest rates will remain low over the balance of this year and next. In addition, the labor market remains strong and wages are rising. Which should support consumer spending. Remember that the consumer drives nearly 70% of all economic activity here at home. And don't forget about the Federal Reserve's easy monetary policies. While the Fed is likely to begin the process of reducing the amount of bonds it buys each month in the open market, we believe monetary policy will not be tight, and our central bankers will likely continue to keep their foot on the accelerator. at least over the next 12 months or more. So Scott Wren believes that they are going to taper at some point and by the end of this year. But tapering is not tightening. They're just going to reduce the amount of bond purchases, that they're doing on a monthly basis. But they're still going to be doing bond purchases, just less. So financial conditions are still going to be very, very loose as they are today. More importantly, they're not going to be raising rates. He goes on to say, Scott Wren goes on to say, that means we want to take advantage of any downside volatility in the stock market to add to positions with potential to benefit from a continuation of the economic recovery here at home and abroad. While it is true that we have not had a meaningful pullback in quite some time, we believe investors should look through the potential near-term downside seasonal volatility and focus on the favorable fundamentals we believe lie ahead. Good stuff. I like it. I agree. That's what we talk. We talk about act on local price weakness with a long-term mindset. Look, if the market's going to dip, it's going to dip. There's nothing you can do about it except decipher, should I be buying or not? That's your job as an investor. We're still in buy the dip mode here with Finom Group. Act locally on price weakness with a long-term mindset. And basically that's a protocol for position sizing. Make sure that any position size, any dip buying activity has an appropriate position size or liquidity such that, look, if the market wants to dip even further, you can, and you still have, plenty of cash on the sidelines to further engage. Take advantage of even deeper value. Again, assuming all of our buy the dip indicators are aligned.
So, where were we?
I was just leaving.
Right, you were leaving.
I can't believe you sent a woman into the sauna to do that.
That was an accident!
I think you're both mentally ill.
Oh.
And by the way, they're real and they're spectacular.
Now that's a classic. All right, what are we doing playing Seinfeld videos here in the weekly state of the market? Well, what we're doing is, and for those of you who are Seinfeld fans, you know exactly what they were talking about. So for this segment of our weekly state of the market, those tips look spectacular. What are we talking about? Tips: Treasury, inflation, protected securities. And this is the chart of the 10-year Treasury inflation protected security. What is that? Okay. The yield on the Treasury inflation protected bond is now at -1%. It's essentially the 10-year bond adjusted for inflation, right? Because when we look at the 10-year yield right now, we can do that actually. It's 1.33%, up 3+ basis points here today, right? But the tips take into consider inflation. And right now, tips are in negative territory at 1.05. That's the yield adjusted for inflation, also known as the real yield. So you'll hear people say, well, what's the yield on the 10-year Treasury? You want the real yield or the 10-year Treasury bond? So this is what they refer to when they say the real yields are negative and the Fed needs to taper. There's too much liquidity. It's hard to argue with people that say that because tips tell you, yeah, they've got their foot on the pedal and it's been on the pedal since, the pandemic. Tracking how the stock market performs relative to the real yield is very revealing because the issue gets to the heart of stock valuation. People constantly, well, the market is overpriced, it's overvalued. What you need to ask that person is compared to what? It's overvalued compared to what? Itself or what most people use for the judging the 10-year Treasury yield. That's your starting place. That's your starting place. The problem, though, with looking at a Treasury yield is that inflation can greatly impact them. That's where the tips come in, because these bond yields are adjusted for inflation. So when people say that the market is overvalued, what am I supposed to do? Am I supposed to go and buy bonds? Because they've got a real negative yield. Think about it this way. You've got a savings account or a money market account at your bank, right? And maybe it's earning, if you have less than $100,000 in it, it's earning less than 0.1% every single month. That's because the 10-year yield is where it's at, and you have tips in negative territory. So what are you supposed to do as an investor? If you want to grow that, if you want to grow your savings over time, if you want to grow your investment portfolio, you got to have a heavier allocation to where the greater yield is. The S&P 500, NASDAQ, whatever, the equity market, risk assets. So the stock market's overvalued compared to what? I can't get anything in my savings account. I can't get anything in bonds. It's not overvalued compared to bonds. It's not overvalued compared to tips. So what we want to know is, okay, is there a signal here based on where tips are in negative territory? The 10-year tip is negative 105. You are actually getting nothing on the yield of a tip here, or the 10-year Treasury bond. I went to the St. Louis Fed economics database, downloaded all the daily closings for the 10-year tips yield, which goes all the way back to 1983. Then I downloaded all the daily total returns for the Wilshire 5000 stock index. Why? Because that's the broadest measure of the total stock market, if you will. So in short, what I found was the higher the tips yield. So if this was, like here, the higher the tips yield, the worse it was for stocks. The lower the tips yield, the better it is for stocks. It's not any more complicated than that. And that basically validates the valuation. It exonerates folks from saying the market's overvalued. If they're saying it's overvalued, they're not following the data. They're not resourced. They're not looking at it. The tips tipping point, the tips tipping point, and those tips are spectacular right now. So what's the tipping point? It seems to be at 0.5%, positive 0.5% on the 10-year tip. Anytime the yield on the 10-year tip is plus positive 0.5% or greater, the stock market has delivered an annualized return, still positive at 5.1%, but that's below the long-term average. That's probably less than the return of the tips bond. But when the 10-year tips yield is under 0.5%, then the stock market has delivered an annualized return of positive 23.3%. Where's the tip now? Remember, the tipping point is 0.5% positive. Right now it's at negative 1.05. Thinking about the Fed, like what's going to get, this is what the Fed is buying, by the way. Every single month they're buying tips, Treasury inflation protected securities, every single day. They're the buyer of last resort. So indeed, people are complaining, you're going to create a bubble. And this is, if we go to the big boy chart here, because this is I'm only showing you in here going back to 2017. But this is literally, max out, this is, as far as it goes here on the website. But this is the lowest level basically ever. This is the lowest level ever. You don't have to like it, as I often say. You don't have to like it. We weren't this low during the financial crisis. You wonder why equities are doing what they're doing. There is no other alternative. Tina, There's no other alternative. You don't have to like it. But if you want to get off of this merry-go-round, so to speak, while the music is still playing, you are actually risking, missing out on further potential upside. I mean, the market is doing exactly what the data says, right? Up 23.3% annualized returns when it's below 0.5%. It's below 1%. Stock market's never wrong. Investors simply need to perform more due diligence. Market's overvalued compared to what? Having said that, just be prepared. Always be prepared. Having the data before you is part of that preparation. With that, I'm Seth Golden, and this has been our weekly State of the Market.